get to a couple of the guys that have made the cut. Julian Emanuel, Chief Equity Derivative Strategist at BTIG, and Lou Alexander, Chief Economist at Nomura, former counselor to Treasury Secretary Tim Geithner. So you've been pretty good, I think, Julian, although you waffle a little. I've seen you go back and forth, but your basic stance has been bullish.
Yeah, and we think next year is going to be a good year as well. We're looking for 34.50.
You've had your moments.
Well, and if you think about it, it's recession because moments. The market has had, no, not recession moments. We have never thought there was going to be a recession.
And tariff.
No, trading moments. Okay. Yeah, tariff, more volatility. But the difference is the Fed is now behind the money markets, in our view, and that is dampening volatility. They're going to do their best to keep the liquidity flowing, not interest rates, as we've spoken about. And that, to us, is one of the elements that's going to cause a better year next year.
Because at one point you were at 3,100 for year-end on the S&P, but then I think you kind of got a little worried about that forecast at one point. Did you not?
It's 3,000 the whole time. 3,000 the whole
above
time.
That, and that was at about 2,750, 2,800 when you told me it could still be 31. So I'm trying to give you credit. Don't push back on me. Okay.
We'll take it.
All right. So minus point. You're the economist in the group. Minus 0.5 or plus 3.0.
We're about in the middle of that. So we're between 1.5 and 2. Look, I did work in graduate school that showed you the standard error on forecasts a year out on GDP growth was 2 percentage points.
Yeah, standard.
So
plus or minus, either way.
Yes. So look.
Beautiful.
I think the forecast last year that the economy was going to slow was pretty clear. That was really a function of more than anything else of fiscal policy waning and the trade stuff having an effect. I think as you look going forward, trade is still the big issue. I think the rest of the world looks a little better than it did at the middle of this year when those recession concerns were
greatest. The U.S. looks a little better, too. The fourth quarter data has been coming in, at least in November, a little stronger, hasn't it?
Yeah. Look, our tracking model has it about 1.8 for Q4. Basically, you had some noise in the data because of the GM strike, so October was weak. November looked a little better. I discount a little bit the better November data in part because of that. But yeah, the economy's doing fine, and we expect it to do fine next year.
So it was trade and a slowdown. So in your view, there's two kinds of people in the world: people that blame the Fed, people that don't. You don't think the Fed got too tight? You don't think that was part of the problem?
I don't think that was a big part of the problem. I don't think it was crazy where they were. Look, with 2020 hindsight, would you have redone the decision in December? Undoubtedly, right? But I don't think they were wildly out of line. In terms of where they ended up.
All right, Julian, a little birdie.
I got the note from the little birdie, too, by the way.
Birdie.
Both of us.
There's big put buying going a year out on the S&P on election worries, and it's bipartisan. It's right, left, and center. Nobody knows. So.
Well, all we know is that if you try to hedge past the election term, the price of out-of-the-money puts versus out-of-the-money calls really reflects, I'd almost call it panic.
Is there volume there? Or?
There is every now and then. And put it this way, it's one of those markets where if you want to find volume, you can find volume. But in general, it's just a reflection of this very, very deep
Normally,
concern.
high put-call ratios are bullish. When people are betting against a downside, usually it's good. So is this a contrarian or
yes, it's a contrarian. Our view is
there's not going to be a problem.
Well, our view is saying if you want to get market exposure, taking the other side of that trade is a very, very good proposition.
Joe, can I just
you remember how much money Buffett made selling puts? So you got a lot of money.
Well, that's what it would be. Yeah.
Okay.
I want to ask Lou on the Fed. Do they have it right here? Is this hibernation idea 6 months to go to sleep and then kind of wake up next summer and see what's going on? Is that the best bet here?
I think so. Look, they put themselves in a position where they don't have to do a lot for a while. As you pointed out, there's a lot of stimulus in the pipeline. And if you look at long rates as well, a year ago long rates were at 3, now they're at 1.8. That's another aspect of the sort of interest rate stimulus that's in the pipeline. Look, if things go bad in the rest of the world, if the trade negotiations blow up, they may have to do more, but they're going to wait to see the data actually weaken. And as you said, we're doing fine now. I think they're in a good place.